Welcome to the Killik & Co podcast for the 6th of October. A quick look at the diary for the week ahead. It's going to be interesting for two reasons. One, the Bank of England is coming through this week with its interest rate decision. You may recall that we had rate decisions from the ECB last week. They normally coincide, but the Bank of England have been given an extra week to mull over their decisions. No change to interest rates are expected, and it will take a week or so to reveal the detail behind the meeting and whether there have been any changes to the 7-2 vote for an increase in interest rates. But that comes up on Thursday of this week. The corporate reporting season has been quiet for a few weeks, but that begins to change. You'll see the first signs of it this week, as on Wednesday we have Alcoa reporting. That normally kicks off the US reporting season. So as we get into next week and the following 2 or 3 weeks, expect those numbers to start to rise, and we'll get a few more companies coming through. There has been an uptick in profit warnings recently. That normally preempts some of the reporting season as companies recognise their failure to achieve market guidance. So hopefully we've got the worst of them out of the way, but it's going to be interesting to see whether the recent sort of market shake-up, both in terms of currency volatility and increasingly of late stock market volatility, is having any impact on business confidence coming forward. Just in terms of corporate results, not shown on this screen, but later today we are expecting to get a first heads up from Samsung, and we'll take a look at Samsung later in this presentation. But failing that, a little bit thin on the ground. So really it's just to turn to some of the sort of charts that are continuing to drive sentiment at the moment. And last week we had an opportunity to hear again from President Draghi on the ECB initiatives at the moment. Quite a large element of disappointment there, lacking detail in some of the speech, but nevertheless we have got diverging trends here with, of course, the US tightening monetary policy and the ECB and indeed the Bank of Japan moving further towards opening up monetary policy and further easing there. And as a result, we are seeing this continued divergence in performance of currencies. This has been taking place really since the summer, and it's building some momentum here at the moment. So that euro we've been featuring for a few weeks, but I just want to keep it imprinted in the mind that this weakening euro at the moment is clearly helpful to trying to resurrect some sort of performance out of the European economies at the moment that desperately need some export help, some competitive help from the currency market in this current environment. Key concern remains inflation. The inflation around the world is continuing to ease, particularly acutely in Europe at the moment, and concerns that any further weakness in the euro is going to require more and more stimulus to assist, and that of course is euro negative. Same with the pound, really. The pound having had that sort of brief Scottish referendum rally we were commenting upon at the time, it was a natural reaction to sort of getting through that particular vote that some short covering, some early buying in the sterling, but it's resuming its very much downward trend, and this is obviously coinciding with strength in the dollar at the moment. So this is now creeping below 160, a level that's not really been seen since, of course, back in November of last year. Quick turn to the FTSE 100. This stock market volatility that we're seeing of late is continuing to sort of create some downward pressure. We are seeing a small rally back from sort of what could be a short-term oversold position in FTSE 100, but having crept into negative territory for the year-to-date number, we ended up being down around 3-4% at the worst, but a little bit of life coming back into it late on Friday and rebuilding again this morning. We're seeing a bit of further momentum to the upside this morning, but it has been quite a sharp correction to the stock market here in the FTSE 100, and that really has been more pronounced here than has been seen some other places in the world, such as the US. But disappointing to see the negative return, but the year to date, stock market still struggling to break through to the upside we commented upon around the 6,900 level. Just in terms of stocks, I mentioned Samsung. We have a sell recommendation on Samsung. Keep an eye out for these results later today. Thinking that Revenues in the third quarter could be down around 15% year to date, and earnings down 45%. So it's being hit very hard at the moment by lower growth sales in the iPhone competition against the iPhone market. The launch of the 6 has, of course, held back orders elsewhere. And Samsung very much under a little bit of pressure at the moment, and those results coming out later today. We do have a sell note on Samsung, so if you still feel you need to take a look at that, it's still in context of where we are in the world and competition in this space, in the smartphone space. I would encourage you to speak to your broker about this company. And finally, really just to sort of highlight this rather strange looking chart known as the VIX, but it is the volatility index. We've been commenting earlier this year that volatility in financial markets remained at almost record lows for very long periods of time. And how long would it be before that begins to change? Well, it's not breaking out too far to the upside, but there's a notable upturn here. I've been commenting for a while that we started to see volatility creep back, certainly into the rates market and also into the currency market, and now it's edging back into the equity market, having her print just above sort of 16. It's well off the lows that sort of nudging down towards 10 in July. That print was certainly the lowest since records began in the VIX. So it's coming off the bottom at the moment. So a little bit more volatility around. That in itself, I think, provides a little bit more opportunity for the more active trader that has been sort of sitting on the sidelines for a while, waiting for just a sort of burst of action into differing trends. So again, just a chart to keep an eye on.